Something just shifted. Overnight, the world tilted on its axis. Missiles flew, headlines exploded, oil futures twitched, currency desks lit up, and somewhere in the background of all that noise, something far more important began to move. Silver. Not quietly, not gently, not politely. It surged. And now the question isn't whether something happened. The question is whether we are standing at the edge of something much bigger. Because when geopolitical shockwaves collide with a fragile monetary system, when military escalation meets historic debt levels, when confidence cracks at the same time supply tightens, markets don't just react, they reprice reality. Silver pushing toward 93, 95, whispering toward $100, gold marching higher, pressing into territory that once sounded insane, industrial metals catching a bid, safe haven flows accelerating. This is not random, this is pressure releasing. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. For years, the global financial structure has been stretched like a rubber band. Debt stacked on debt. Derivatives layered on derivatives. Sovereign balance sheets bloated beyond comprehension. Central banks expanding liquidity whenever markets trembled. The system learned one response: print, stimulate, intervene, suppress volatility. But what happens when the shock isn't financial? What happens when it's geopolitical? Markets can model inflation. They can model interest rates. They can model unemployment, but they cannot easily model escalation. They cannot neatly quantify uncertainty that spreads across borders in real time. When missiles launch, traders don't wait for spreadsheets. They move. Capital flees risk. Capital hunts safety. Capital searches for assets with no counterparty risk, and that's where silver changes character. Most people misunderstand silver. They treat it like a smaller, more volatile version of gold. But silver lives a double life. It is both monetary and industrial. It is both inflation hedge and manufacturing necessity. It is both fear trade and growth trade. When geopolitical stress erupts, silver can ignite from two directions at once. First, fear. Whenever global tensions rise, safe haven demand expands. Confidence in currencies wavers. Investors rotate out of risk assets. Bonds don't feel safe when inflation is already elevated. Equities don't feel safe when supply chains could be disrupted overnight. And cash doesn't feel safe when central banks have shown they will sacrifice currency value to stabilize markets. So capital flows toward tangible stores of value. Gold leads, silver follows, and then often accelerates. Second, industry. Military escalation threatens energy corridors, energy volatility impacts manufacturing costs, sanctions reshape trade flows, shipping lanes tighten, supply chains fracture, and in that chaos, nations begin stockpiling strategic materials. Silver is not decorative. It is critical. It is in electronics, solar panels, medical equipment, defense systems, advanced manufacturing, communications infrastructure. It is embedded in the modern world. Disrupt supply, and the industrial bid tightens. Increased geopolitical competition, and strategic reserves expand. Now combine those two forces, monetary fear and industrial demand, inside a market that has already been running structural deficits for years. That is not a mild setup, that is explosive. For over a decade, silver production has struggled to meaningfully expand. New discoveries are scarce, permitting delays grow, environmental restrictions tighten, ore grades decline. Meanwhile, green energy initiatives multiply silver's industrial use. Solar alone consumes staggering quantities. Electric vehicles increase demand for conductive metals. Digital infrastructure expansion requires silver-based components. Supply tight, demand rising, add geopolitical shock, add currency uncertainty, add capital rotation. Now ask yourself, is $93 extreme or is it early? Look at the macro backdrop. Global debt has crossed levels that once seemed impossible. Governments owe more than their annual economic output. Interest payments alone are beginning to rival defense budgets. When rates rise, debt servicing strains budgets. When rates fall, currencies weaken. It's a trap. Central banks are cornered between inflation and recession. Tighten too much and economies contract. Ease too much and currencies erode. Into that environment comes military escalation. Oil prices spike. Energy feeds inflation. Inflation pressures central banks. Central banks hesitate. Markets sense hesitation. Precious metals respond. Silver does not wait for official confirmation. It front-runs policy weakness. It senses when real rates will be sacrificed. It anticipates currency debasement before headlines catch up. And right now, the backdrop is combustible. Consider how fragile confidence already was. Banking tremors, regional institution stress, commercial real estate pressure, sovereign bond volatility, political polarization, trade fragmentation, de-dollarization murmurs growing louder in emerging markets, then layer conflict on top. Confidence does not improve. It cracks further. And when confidence cracks, tangible assets strengthen. The surge toward $95 is not about speculation alone. It is about repricing risk. Risk of wider conflict, risk of disrupted oil flows, risk of retaliatory sanctions, risk of currency instability, risk of supply chain fracture. Markets are forward-looking machines. They do not wait for outcomes, they price probabilities, and when probabilities of escalation increase, so does demand for assets outside the financial system. Silver sits outside. No earnings report required. No board of directors, no bankruptcy court, no central bank printing press. It exists. It conducts electricity. It reflects light. It has been money for thousands of years. And in moments of stress, humanity remembers that. Now let's talk psychology. Markets move not just on data, but on narrative. A surge above $90 breaks psychological barriers. Round numbers matter. Traders anchor expectations to milestones. Once $90 falls, $100 becomes imaginable. Once $100 becomes imaginable, positioning shifts. Short sellers reassess. Momentum funds pile in. Retail interest returns. Industrial buyers hedge forward supply. The gold to silver ratio compresses. Acceleration feeds acceleration. This is how parabolic phases begin. Not from calm, but from tension. Is $100 guaranteed? Nothing in markets is guaranteed. But what matters is structure. Is supply elastic? No. Is demand shrinking? No. Is geopolitical risk fading? No. Is debt declining? No. Is currency confidence improving? No. Then why assume silver should stall? History offers perspective. Precious metals have surged during wartime uncertainty before. They have surged during inflationary spirals. They have surged when monetary credibility weakened. The difference today is scale. Debt levels are larger, derivatives exposure is larger, global interconnection is deeper, supply chains are more complex, energy dependency is greater, information spreads instantly, capital moves instantly. When volatility hits, it cascades. The modern financial system amplifies shocks, and silver thrives in amplification. Now consider another angle, currency competition. As geopolitical blocks harden, nations seek insulation from sanctions. Reserve diversification accelerates. Gold purchases by central banks have been strong. Silver, while less official in reserve status, rides that wave of metal legitimacy. If global trade fragments further, if parallel payment systems expand, if dollar dominance faces incremental erosion, tangible commodities gain relative importance. Silver does not need to replace currency. It only needs to absorb doubt, and doubt is growing. Energy markets are particularly critical here. If escalation disrupts oil supply routes, energy costs ripple across every sector. Manufacturing margins compress. Consumer prices rise. Central banks face renewed inflation pressure. Precious metals are historically sensitive to energy inflation. Silver, with its industrial exposure, reacts both as inflation hedge and input material. This dual sensitivity creates volatility, but in the direction of stress. Now let's zoom into positioning. Futures markets often show heavy short exposure in silver. Large entities hedge production or speculate on price direction. But when price breaks technical ceilings during geopolitical stress, those shorts become fuel. Short covering is not optional. It is mechanical. Buy to close. Push price higher. Trigger stops. Cascade. This is why silver can move faster than gold in crisis windows. Its market is smaller. Its liquidity thinner. It requires less capital to move price dramatically. That volatility works both ways, but during escalation, upside can outrun expectations. Add to that retail resurgence. When headlines scream conflict and metals spike, public attention returns. Physical demand increases, premiums expand, inventory tightens, paper price and physical price can diverge, confidence in paper contracts weakens, demand for physical ownership rises. That dynamic alone can strain supply chains further. Industrial buyers do not want to be caught short during volatility. They secure inventory, they hedge forward, they increase stockpiles. Each incremental layer compounds demand. Meanwhile, mine expansion cannot accelerate overnight. Exploration cycles take years. Capital expenditure requires stable environments. Conflict increases uncertainty, which delays investment, so supply response lags, demand response accelerates. That imbalance defines bull markets. Now consider time horizons. Short-term traders focus on Monday's open. Will silver gap higher? Will profit-taking hit? Will volatility spike? Those are tactical questions. The strategic question is deeper. Has the risk premium in precious metals permanently reset higher? If the world has entered a phase of sustained geopolitical fragmentation, then safe haven demand is not a one-week event. It becomes structural. If energy corridors remain contested, inflation risk remains embedded. If debt continues expanding, currency dilution remains embedded. Silver does not require catastrophe. It requires imbalance. And imbalance is everywhere. The surge toward $93 may be only the visible tip. Beneath it lies a convergence of forces years in the making. Underinvestment in mining, explosive growth in green energy demand, mounting sovereign debt, rising geopolitical polarization, and eroding monetary credibility. Conflict did not create this bull case. It accelerated it. It exposed it. It ignited it. Now markets must decide how far to reprice. Is $100 psychological resistance? Yes. Is it fundamental resistance? Not necessarily. Once broken, new narratives form. Analysts revise targets. Momentum strategies reweight allocations. Institutional portfolios reconsider exposure. Silver transitions from neglected to necessary. And transitions are rarely linear. They are volatile. They overshoot. They correct. They resume. Anyone expecting a straight line misunderstands the metal. Pullbacks will come. Profit-taking will hit. Margin calls will force liquidation in moments of stress. But the broader structural thesis remains intact as long as the underlying imbalances persist. And right now, those imbalances are intensifying. Military escalation does not resolve debt. Sanctions do not strengthen currencies. Energy disruption does not reduce inflation. Political fragmentation does not rebuild trust. All of those forces lean in one direction, toward assets outside the system. Silver sits there, waiting, rising, testing $95, whispering $100, and asking whether this moment is just a spike or the beginning of a repricing cycle that few are prepared for. Now step back even further, because the real story is not just price, it is fragility. For decades, the global financial order rested on confidence. Confidence in currencies, confidence in sovereign debt, confidence in the ability of central authorities to stabilize shocks. That confidence allowed leverage to expand. It allowed deficits to balloon. It allowed risk to compound quietly beneath calm surfaces. But systems do not break gradually in headlines. They fracture in stress. Military escalation is stress. It forces choices. It forces capital to reveal where it truly feels safe. If the reaction in metals is this strong already, what does that signal about underlying anxiety? Silver approaching $100 is not merely a commodity story. It is a signal that trust is thinning, a signal that diversification is accelerating, a signal that tangible scarcity is being repriced against intangible promises. Consider the velocity of information today. News spreads globally in seconds. Traders respond algorithmically. Capital shifts electronically. Fear multiplies digitally. That speed compresses cycles. Moves that once took months now unfold in days. When silver jumps $5 in a session, that is not normal volatility. That is repricing under urgency. Urgency changes behavior. Industrial buyers do not debate macro theory during urgency. They secure supply. Investors do not analyze decade-long spreadsheets during urgency. They protect capital. Hedge funds do not wait for quarterly guidance during urgency. They reposition risk, and repositioning risk in a small market produces outsized moves. Silver's total market capitalization is tiny compared to global equities or bonds. It does not require sovereign wealth funds to reallocate trillions. It requires incremental flows to overwhelm available liquidity. If even a fraction of global portfolios seeks hedging exposure simultaneously, price can accelerate violently. And this is where the geopolitical backdrop becomes critical. Escalation does not remain isolated. It triggers alliances, retaliations, diplomatic fractures, supply realignments, energy producers respond, shipping insurers reprice risk, commodity traders adjust contracts. Each adjustment embeds uncertainty into pricing models. Uncertainty increases volatility. Volatility increases hedging demand. Hedging demand increases precious metals exposure. This feedback loop can persist long after the initial headlines fade. Meanwhile, inflation remains unresolved. Even before conflict, price pressures had embedded themselves in housing, services, food, insurance. Energy spikes amplify those pressures. Wage demands follow. Central banks hesitate between tightening and supporting growth. Real yields become unstable. Precious metals are sensitive to real yields, the difference between nominal rates and inflation. If inflation expectations rise faster than rates, real yields fall. Falling real yields historically support silver. So now you have geopolitical risk, industrial demand, inflation pressure, and monetary constraint converging simultaneously. That is not coincidence. That is alignment. And alignment creates trends. Critics will argue that silver is volatile, that it overshoots, that it corrects sharply, all true. But volatility does not negate direction. In fact, volatility often precedes structural revaluation. Look at long-term charts. Periods of compression are followed by explosive expansions. When silver breaks multi-year resistance, the move is rarely timid. The reason is simple. Long consolidation builds energy. Years of suppressed pricing, years of underinvestment, years of short positioning all create stored potential. When catalyst meets compression, release follows. Military escalation may be that catalyst, but beneath it lies something deeper: currency dilution. Global money supply expanded dramatically in recent years. Liquidity injections were necessary to prevent systemic collapse during crises, but liquidity does not disappear easily. It circulates. It inflates asset prices. It distorts valuations. When confidence wavers, that liquidity seeks hard anchors. Silver becomes an anchor, not because it yields income, not because it produces dividends, but because it cannot be printed. And in a world where everything else can be expanded digitally, scarcity becomes magnetic. There is also the strategic dimension. Nations watching conflict reassess reserves, strategic stockpiles are reviewed, critical mineral policies are rewritten, supply chain resilience becomes national security. Silver is classified among critical materials in many frameworks because of its industrial indispensability. If governments encourage domestic stockpiling or subsidize secure supply chains, baseline demand shifts upward. That shift is not speculative. It is policy-driven. Policy-driven demand is sticky. Add private investor demand on top, and the floor rises. Another dimension often ignored is derivative exposure. Precious metals markets are intertwined with complex financial instruments. Leverage magnifies price swings. When volatility spikes, margin requirements increase. Participants either add capital or liquidate. Liquidation can cause short-term drops, but once weak hands exit, stronger positioning remains. In rising environments, each correction becomes shallower as conviction builds. If silver consolidates above previous resistance levels, technical traders interpret that as confirmation. Confirmation attracts capital. Capital reinforces trend. Trend shapes narrative. Narrative shapes behavior. And behavior moves price. What about $150 projections? Are they fantasy? Consider historical peaks adjusted for inflation. Consider monetary expansion since prior highs. Consider structural deficits in supply. Consider electrification trends. Suddenly, triple digits no longer sound extreme, but numbers alone are not the essence. The essence is trust. Do markets trust fiscal discipline? Do markets trust that debt will shrink? Do markets trust that geopolitical fragmentation will reverse? Do markets trust that energy stability will return quickly? If the answer trends toward no, then hedging persists. Silver thrives in persistent doubt. Now imagine escalation broadens. Oil surges further. Shipping costs spike. Emerging market currencies wobble. Bond markets demand higher yields to compensate for risk. Governments face rising interest burdens. Policymakers choose between austerity and monetization. History shows which path is politically easier. Monetization, which dilutes currency, which supports precious metals. This is not alarmism. It is pattern recognition. Every major monetary expansion cycle eventually confronts confidence limits. Sometimes the limit arrives quietly through gradual inflation. Sometimes it arrives abruptly through crisis. Either way, tangible assets benefit. Silver's recent surge may be the market's early recognition that the confidence buffer is thinning. Even if immediate tensions de-escalate, the precedent remains. Risk premium does not fully evaporate after one event. It embeds itself into pricing models. Think of it like an insurance premium. Once insurers experience a major loss event, premiums rarely return to prior lows immediately. Risk is recalibrated higher. Markets function similarly. Once geopolitical volatility proves real, safe haven allocations may stabilize at higher baselines. That supports metals structurally. Of course, nothing moves vertically forever. Corrections will test conviction. Media narratives will swing between euphoria and panic. Analysts will downgrade and upgrade in cycles, but structural forces outlast headlines. Underinvestment in mining cannot reverse overnight. Electrification trends will not disappear. Debt burdens will not vanish. Geopolitical competition will not dissolve instantly. As long as those conditions persist, silver remains fundamentally supported. Approaching $100 is symbolic. It signals transition from disbelief to acceptance. Once acceptance forms, new targets emerge. Market participants who once dismissed silver as stagnant begin recalculating exposure. Portfolio managers reassess allocation percentages. Industrial users lock in longer-term contracts. Retail investors seek physical ownership. Supply tightens further, and volatility increases. Volatility in rising structural environments is not weakness. It is energy. The world is shifting from an era of complacent globalization toward an era of strategic competition. That shift changes how assets are valued. Efficiency once dominated, now resilience dominates. Just-in-time supply chains once minimized inventory, now stockpiling returns. Financial engineering once overshadowed tangible production. Now tangible resources regain prominence. Silver sits at the intersection of finance and industry. That intersection is where repricing becomes dramatic. So the question is no longer whether silver can touch $100. The deeper question is whether the monetary and geopolitical environment has entered a phase where triple-digit silver becomes not extraordinary, but rational. Markets are beginning to answer. They are not whispering. They are moving. This is not just about a price spike on a headline. It is about a world under strain, currencies under pressure, supply chains under stress, and capital searching for certainty in uncertain times. Silver's surge toward and beyond $93 is a signal that something deeper is unfolding beneath the surface of markets. Whether it pauses, pulls back, or powers through $100 next, the forces driving it are larger than a single event. They are structural, they are global, and they are accelerating, and that is why this moment matters.